And morning, true scalpers. Welcome to another live true scalping session with the Mohawk Forex scalping team. We're going to be live for the next couple of hours, just seeing how the market is going to react. US-30 and gold obviously is what we trade on the 3-minute time frame. We're going to see how the market is going to react to the upcoming balance of trade, which is October's results. It's always 1 month previous in 8 minutes time. So we'll have a look at scalping this. Obviously the way we do that, we go the opposite direction, and then we'll try and scalp in the direction of the news for the New York Open. At the same time, we've got this non-farm productivity, unit labor cost, medium impact, but again, all helps push gold, US-30, whatever you trade in, you know, it could be pound, dollar, euro, USD, whatever, in the right direction. But we stick with US-30, the Dow, and gold, of course, as you know, for those of you who've been watching these live streams. We're on the 3-minute time frame using our Axe trading system that you get access to once you become a VIP member of our Discord group. All the information on that is at www.mohawkforex.com, our website, and also in the description of the YouTube channel below. So yeah, let's have a quick look at this balance of trade. We always trade it every month, and as you can see, a previous figure of minus 80 billion, we're predicted to be a minus 66, so a lower result. And as you can see from this, a lower than expected figure is negative. So on this one, we would expect to sell gold and buy the US-30 if this result is away from the consensus, i.e., you know, 64, 65, something like that. Or on the flip side, if this ends up being 67, 68, better than expected, then obviously we will buy gold and sell the US-30. And we're looking for about 50 to 100 pips on each of those. We usually enter a couple of trades right on the actual news release, and then try and catch some pullbacks, and that's the name of the game. And we're in and out. Stop loss is all based on our points of interest grid system, which we've got here, which are major support and resistance zones. We've got our breakout zone, which is the green and the orange dotted lines, which is all based on previous information. We've got our dashboard, which gives us a picture of what's going on bigger time frames as well. And we've got our RSI scanner with divergence included, those who like to check out divergence. And we stick to the 3-minute time frame. We don't mess around with other time frames. All the information I need to scalp is on this time chart. And that's the whole thing about this kind of true scalping, is, you know, trying to keep it simple as possible. There's enough confusion with trading, Forex, indices, etc. So we try and keep it as simple as possible. And obviously we keep an eye on the news. We're fundamental traders primarily. So we just keep an eye on Bloomberg as well, having a listening to what they're saying. Because obviously the Omicron news is still affecting the market. There's news about China, Evergrande, Fed tapering, interest rates. There's a lot of news kicking around at the moment. So it's going to be interesting to see if this balance of trade actually does anything. I mean, sometimes you can get these trade events and you don't get much of a move because other bigger news events override them. I use my FX book. There's plenty of other websites out there that give you the economic news as it comes up. I like how it's kind of laid out, and it tends to be pretty quick as it can be. It's a little bit quicker if you use it on your phone and the phone app. I have on here for the YouTube, just to show you can have it on the website as well. So we had some results earlier on. Look, the German, the ZEW, which I didn't trade today, but yeah, the ZEW at 10 on DAX was round about. Hey, look, there you go. As you can see, it would have entered about here, and obviously it would have been a nice as you can see, 957. That's your entry point. And TP, you either hold for the breakout line or for 100 points, whichever is, to me, nearest. 100 points would have been achieved in kind of like 6 minutes or so. So that was a good win. on the ZEW if you took it. No, print that back testing purposes. So you could have had that as a nice win. So we're looking at US-30, which obviously has been a nice big bull run for the last session. Peaked out there at 35.635, pulled back. It's in a range as you'd expect before news and the open, up between these two areas here. That's fine. And gold, as you can see, has took a massive drop, formed a beautiful M, second leg, did a beautiful W. Look at that for a W. I mean, that you just can't, for people who don't believe markets going waves and patterns, you know, it's right here before your eyes. A nice W, double tap on the bottom, almost a double tap, kind of an M, you know what I mean? It's a double tap there, look, bang, bang. So head and shoulders basically, to cut the head off, and our zone gives you the entry point for a head and shoulders move on gold. Here, look, you see, I'd have been out between here and here, look for 100 points, well no, it was perfect, look, with the spread, 100 pips. So we had a head and shoulders, and we've had a nice W pattern, and now we're looking for this pullback again on gold. But it depends on the news. We should have been in on a sell here, to be honest with you, while I was talking away. As soon as we hit our oversold zone, look, the 25, we should have been in there, and it's pushing down, and we should have been looking for just 50 points. Quick flash in and out before the news. But as you can see, the news is approaching. 2 minutes to go. Just looking at the market update, see where we are, what Bloomberg's saying. I mean, DAX is so overbought, 2%, you know, it's due a kickback. So, you know, the DAX might follow US-30 if it's the bad news. That's wait for the US-30. Dow Jones is 1.87, SP 500 and NAS also fairly high. So good news might give us a bit of a pullback, might be a bit of market manipulation that we love to trade. So here we go, we've got a minute to go. See this countdown. Good. In gold, we're counting down, 1 minute to go. So the lower the figure, which you didn't see, the lower the figure, the worse it is. We will go the opposite direction to try and capture some market manipulation. Firing out. Kind of all the other news is in focus. Now this will be interesting to see what kind of result we get from here. Keep an eye on Bloomberg, what they say anything about it as well.
So do you ever commune with Conrad Hilton? Do you ever get any
About 10 seconds to go.
saying you're doing a good job protecting my name?
I haven't, but I did meet his
So all three news events would be nice if they're all the same direction.
and suggested to me Conrad as well.
So it's worse than expected for the productivity and for the balance of pay. Worse than expected, so we're going to go in for a cheeky buy. Get some sells in gold. See what we get. Let's buy 4 trades open. You can see it was 67.1 So,
San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Have a great evening. To recap the headlines.
see what we get.
Thinking about those
So,
dynamics.
gold being nicely the way of the news. Not going to be crazy on this at all.
For many US-based investors, there are basically
Listen to
2 days left this year.
well.
This Friday, the CPI report in America. There is next Wednesday.
Brilliant. There we go. It's got $100 on plus on gold. We just close that out. You can see all dropped.
There are some moves in this bond market I want to discuss. 145 on 10s. Your high of the year, your intraday high of the year on a 10-year yield was
There's
170.
the balance.
The end of March 30th to be precise. Your high of the year on the 2-year right now up 4 basis points, 6
Trade.
and that's contributed to the
Use.
flattening we've seen on this yield curve. Tom, as you
Bang.
pointed out, and we've pointed out repeatedly over the last week or so, your yield curve, the distance between
Perfect.
2s and 10s, it's
The gold goes with the news. Worse than expected result.
79 basis
On
points.
that.
4 digits. I want your 2-year yield, John. 0.6712. I don't know. Is 0.70 is that a big deal?
I guess it's a big conversation. However, is that it? Jimmy Robbins Hip said we've topped out on both 10s
Oh, there's
and on the
a
front end
raging
too.
debate here.
That's very contrarian, Tom. And this market, there are people out there who believe we stall out at 175. There are others who think the funds rate, Tom, has to go much higher.
I've got 8 ways to go.
We've got 34 and 50 on that, so it was about 125.
Thrilled to extend the conversation to give you global industry perspective.
Look what US-30 is going to do.
Chief investment strategist at Yardeni
Again,
Research.
we always know US-30 moves really slow. Pre-market, we know this.
Digit inflation, and then on to Parchment at Yale University. And I thought, there we go. Thank you. Good morning, Cornell on radio. I want to go to the Krugman essay last week where he destroyed monetarism and said simply, it was a theory then, it's not now. What should we do with our collective memory of the
Beautiful, but it's easy to figure out when you just look
Milton Friedman?
at the market. Yeah, it's ranging down at the moment. We're going to hold. We want this. Want that to be our over here. Again, just 100 points is what we're looking for. Just that group.
There were some very powerful forces that kept inflation down. Disinflation was the law of the land for many, many years following the Great Inflation of the 1970s. It was things like globalization, innovation.
And as you can see, you know, what helped there was the productivity was also, you know, worse than expected as well. So 2 against 1. I mean, they're medium impact, but it's still good if you get any kind of news event to give you the market the push in that right direction. So that's all good. So let's just have a look where we are.
Help us with the distance here from Dartmouth College and David Blanchflower, Hanover, New Hampshire, in the University of Cambridge.
30. It's a
Arian. They are polar opposites on the inflation guess. Where do you stand on
quick
that?
look on your chart. Reject off this line here. Wait for the neutral zone. We'll see. Like I say, you know, we've got the buys in, but we can do a sell if we have to down here for catching the buy. No panic.
For the consumption deflator until the middle of next year, and then I think it does.
Nothing has been printed on
4%. I don't think it's going to go back to
Bloomberg. They kind of ignore that one. So we'll just watch price action here on US-30. Let's just zoom in.
raising the Fed funds rate by maybe 2
Yeah,
basis
just zoom right in on that.
I think they might also seriously consider raising the inflation target, moving the goal from 2% to 3%.
Ed, so a lot of people are looking at a Federal Reserve that is still responsive to market turmoil, that basically if they do signal that they're going to raise rates next year and there is some sort of tantrum, they'll step in and ease conditions. How much is that anachronism at this point, given that it is a very different paradigm?
I think it is. You're absolutely right. It's a different paradigm, and we've had 4 taper tantrums since 2013. We had one in May 2013, and then we had another one in early 2016, one in
News while we just
Christmas 2018, and then this one. This one is a work in progress. It's not clear just how it's going to play out. But I think that the big difference is this time around the
Oh,
Fed
the
came to give
balance.
the market
Trade
what it
news.
wants, which would be okay. Back off, don't taper so much.
Size 49.48. It's coming down a little bit, but that's fine.
Was real, and the Fed
Wait,
made it very
catch the
clear
buy.
that, they're now concerned about it. So it's going to be pretty hard for them to back off.
Although I do notice in the data, there's been a real shift over the past few weeks, that people are bringing down their longer term expectations once again for inflation. It seems as if people are convinced that a Federal Reserve hiking rates in the near term will allow growth to revert to something similar to what we've seen in the past, albeit possibly even lower based on the demographics you're talking about. Is that a reality in your perspective? Does this give them leeway to hike a couple times, let it go, and actually have a smooth exit?
I hope so. I think that's the consensus view. Maybe it's wishful thinking. Maybe, the pessimism about the near term.
There you go, pushing up, just as I said.
Look, first and foremost, I don't think this is going to wind up to be like the 1970s.
Watch this, see if it breaks the trend line.
Going on right now, like a wage price spiral.
There we go. So we're not going to be greedy because we've messed around a little bit with it. It might shoot up higher, but we can catch this again on the actual open as well. But let's see if we can get $70 maybe. Let's retract off that line. We'll just hold. We're in the green. About $34 drawdown. It's fine.
Hey, Giordani, I want to go to your book, and I want to say it is a triumph to Meghan Desai of the London School of.
This is all manipulation we're trading, you see, and obviously you're trading in a range as well, but it shows you how you can scalp in a range and still get some nice profits. Pre-New York Open as well, pre-market open, this is what we're trying to trade.
Different than the profits of December of 2000.
Absolutely. I mean, in 1999 and 2000, a lot of the profits in technology
measure the gap.
What you look for. No serious business plan. Ordering technology and paying for it with credit.
185. You only want 100.
Situation back then was that you had telecom companies seller financing their customers, so those profits were kind of phony, and it was a period where there was a lot of manipulation of profits. This time around, these are very real profits. They're based on very real businesses, and I think technology is the wave of the future. It always is, but it's more so than ever.
How do you respond to the cry of 15 years that the profits are all going to a few?
Well, there is this kind of Marxist view out there that if
still ranging around,
must be exploiting
fine.
somebody.
Like I say, if it comes up again, we'll probably just end the trade. But see, oh, there's no panic here because I'm expecting it to push back up again, range a little bit more. Look, it's not crossing our average line. This is ideally where you take the buy once you get that cross, like on here. Look. It's where I would have gone in. We went for the buy just after that. So, and we've got a nice support line on our KG line there. Look, our baseline gives us a nice area.
And a crony is whether you can afford lobbyists or not. I can't, and I've got to compete. I've got to give customers the very best. So, in my book, I also argue that Adam Smith did a terrible job of marketing capitalism by telling us that it's all about selfishness. It's not selfishness. It's insecurity. I'm going to go out of business.
Watch price action.
Customers the very best of what I have.
I'm sure that that's a harder sell, that capitalism, go for it because it's based on insecurity. I do wonder, though, Ed, just going into the realm of trading, going into the realm of how you position in such a tenuous period, given that you do feel overall optimistic about productivity, but a little bit concerned about the Fed and how that all shakes out. Have we already priced in the dynamism in technology, the productivity gains that you're expecting, or do you think that that will fuel further gains in the headline indexes next year?
Well, look, I think the best is yet to come for us in terms of prosperity, in terms of standard of living. I think technology is going to solve a lot of our problems. It is solving a lot of our problems. We're not going to get double-digit increases in the stock market anytime soon. The earnings peaked on a year-over-year basis in the second quarter, and that doesn't mean they go down. They just grow at a slower pace. So I'm predicting that we go from 4,800 by year end. So we're getting close, but no cigar just yet. and then something like 5,200 by the end of next year, and 5,500.
Yeah, RSI is back down to that level again. We're ranging around the same kind of zone. So let's just flip to gold and have a look at gold. Look at that. Gold really did follow the news. Perfect entry. Here was the news. And drop a line on it actually, so everyone can see where you would have entered the sell. Right on there, bang. That would have been your. And on the US-30 for the buy, the manipulation buy, we entered there.
Up to 67
Right.
basis points this morning, Tom. And just a gap lower on euro dollar. If you get to an intraday shape of the chart of euro dollar right now, just a gap lower to 112.30.
Now, like I say, we're in, but we will hold for a sell. If it breaks here, we'll get a sell down to here. That's perfectly fine. Because we're playing with today's house money anyway, and 149, and we're in a range. So we're in a range. It means price can go both ways. You know, we're not in a trend with like US30, like your gold here. Look, you're not going to take a buy at the moment. You know, it's ludicrous because you're in a trend going down.
And because of the snow last week, Tom, they're a game short. They've got a lot of games to play. The Christmas period's very busy for Premier League football. So they wouldn't want to postpone the game, but if they've got a lot of characters missing, they might have to do that
And we
because
don't
of
know
that
who
COVID
they are.
outbreak.
We don't know if it's like
I
Mr.
haven't
Kane or
I
others.
haven't got that level of granularity right now, Tom. I haven't got that detail.
You're like hardwired in. I thought you.
No, well, I've been doing a show for the last couple of hours, so I'll try and find out afterwards.
Let's see if we get a push back up on this.
And Jill Carey Hall, US equity strategist of
Like
Bank
others.
of America. Well, you've been doing a show too, Lee. So you suggesting that Tom hasn't been doing the show with
I
us
will
this
just say,
morning?
I thought he was asking, what do the Tots do with the 111 euro dollar? And I was thinking, where's this going to go?
Is he talking about the transfer season
Exactly.
and euro sterling?
Exactly. Is
And
this gonna
going
be
on
an
a
issue?
spending spree on the continent. That would be smart, Lisa. I'm just not sure that's where we were going just then. Up 62 on the S&P, advancing 1.3%. This is Bloomberg.
With the First One News, I'm Ritika Gupta. President Biden will warn Vladimir Putin today that Russia would face severe economic penalties for invading Ukraine. The two leaders will have a video call. A senior administration official says that the president also will tell Putin there would be benefits if he makes a commitment to diplomacy. China warns the US it will pay a price for its diplomatic boycott of the Winter Olympics. The Biden administration has decided not to send any officials to February's games in Beijing. China's foreign ministry says the Olympics are not a stage for political stances or manipulation. Instagram will encourage users to take a break from time to time. The photo-sharing app owned by Facebook parent Meta Platforms will let people opt to see pop-up messages when they have spent a lot of time looking at a particular topic, suggesting they look at something else. Instagram also will remind users about alternatives to social media, such as going for a walk. A leadership change at American Airlines. CEO Doug Parker is stepping down at the end of March after more than 8 years in the job. He'll be succeeded by Americans President Robert
Again, RSI still in that neutral zone. Breaks here and here, we'll go for a sell. Why not? While we're waiting for the buy, we'll take the sell. Like I say, gold is always the best performer pre-market. US-30 always takes its time, then moves in the New York Open, but gold is the runner. Look at that. See? Most people would have probably bought gold. This is where the manipulation comes in. We will buy gold, but we'll wait. We'll wait for the open in 45 minutes. Let's just watch US-30. Obviously still in the range. Not doing anything spectacular at the moment.
front, when your shares are down 20%, it's going to hurt. But talk to us about.
There we go, just breaking now. Look, see, I wonder if we can. Just looking to see if there's a potential. Again, you're only more than 50 points if you are going to take a sell on this. It came out of the zone here, 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 and here. Look, and each time it was a fake out because you're in a range. So you don't just go, oh, this is the one, this is the break, this is it. It's going to dick. It's not. No, it's going to stay within this range, but it doesn't mean you can't scalp it. I'm just going to leave it and watch it and see. I can see you want to see some air, like on here, that you could have got in, got out on 20, 30 points. Yeah, look, easy 50 points on that.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Sometimes you got to sit on your hands and wait.
The world's urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
We've been seeing input costs in one way causing a lot of disruptions.
Size 40 look, so dropping a little bit there. Coming out the zone, bit of air. Are we going to get enough for 50 points? Would be just here, look, 50. We know it's going to come back. Yeah, we're looking for that double top tap before we get the second leg. But we're kind of looking for, zoom out and see the bigger picture of what we're dealing with here. Look, that was the kind of crazy W, look at that, and then the big second leg with kind of pullbacks, look, the W to an M, W, little M, W, M. Well, you can see the patterns. So little patterns within bigger patterns, the way it works. With the RSI here, like, it's just look back at where it's done before. Hasn't been any kind of major sell-off, the same as there hasn't been any major buy or range. Without looking at the main chart, you can see what's going on. Like I said, the thing about putting a sell in here, if you want, is that that's where we're going to be on the open. As long as you can hold it for 45 minutes, you know, there's nothing to worry about, because we're looking at this being a sell. Down to here now as well for the open.
You know, I've been watching the Peter Jackson documentary on the Beatles.
Yeah, look.
They had a very short tenure, but they were the greatest of all time. And Peter Lynch, very parallel. How long did he run Magellan for? It was barely a decade.
That's what we're thinking for the New York Open.
Like his, especially in terms of that size. It's one thing to do it with.
And for gold, we want this to bounce off that heavy support reach up. Like 1775 would be nice. TP, we should put it in there. Look. If it doesn't break, that is the profit area on the open.
So first, I've
NY
interviewed both of the gentlemen you mentioned. I've interviewed Peter Lynch at the MIT Sloan Conference, and Will Danoff was a guest on Masters in Business. And it's very, very clear that they have a very specific methodology. They have a process that they use. They continually refine that process. It's very empirically driven. Lots of people try to do that, but very few have succeeded. Lynch gives a lot of credit to the infrastructure and the support he got at Fidelity. And so in some cases, size becomes a giant advantage when you could throw a ton of resources and the best and the brightest at your process and at your fund.
Barry, has the game changed, though? And this is what a lot of people have been saying, that with the increasing influence of central banks and some of the extreme actions that they have taken, the game has shifted and you are not likely to get ahead of anyone trying to predict these market moves. You just have to bet with or against an index, and that's it.
Well, don't send me back to my college philosophy classes to start quoting Heraclitus. The game is always changing. It's never the same. If you're not constantly refining, iterating, adopting, you will be left behind. And that's some of the things that Lynch did and people who followed him. Will Danoff, people thought he was a dinosaur. The guy has consistently been on the cutting edge of tech and new ideas when younger people missed it. Here's a guy who people looked at as saying, the track record, how can this guy possibly compete? Yeah. It's a young person's game. The secret is you must continually iterate. You must continually adapt. The market is always changing.
Sure.
All right, so now it's the Fed. Before it was fiscal policy. Before it was money flow. It's never the same. You must avoid becoming an expert in the way the world used to be. That doesn't work.
Barry, I do wonder when clients call you and they say, should we just be all in indexes and just get the composition right and we'll be better off? And you say, focus on the fees, or do you say, actually, there are some active managers that have consistently outperformed? How do you position the advice that you give based on this passive-active dynamic?
And I'm going to just point to what Peter Lynch said today. You can't be all in on index to the exclusion of everything else. So a good concept is have the core of your portfolio be a passive index where you're guaranteeing yourself you're going to get pretty close to market results. That's the base. If you want to build around that and say, I want to have a little more technology, I want to try and identify some early stage companies.
And US-30, let's have a look at the sale. Yeah, we're just going to close that now. Excellent. There we go. Click US-30. Yeah, perfect. Look at that. Hit our TP. So we grabbed 48, 76 and 49, so £100, so that was about $135 there. There you go, on the sell, because we'll sell again on the open. We need to sell again now, because we obviously will want to get in on a buy as well.
Came up with a concept off of Sequoia, I'll say, called the Fidelity 50 Fund. It's been merged in 2015. And then, is it better to hold in a mutual fund, in an ETF, a lesser amount of issues, or do you believe in what Phil Correa believed in at Pioneer?
So two parts to that question. First, academic research has shown us that the vast majority of returns and excess returns come from a tiny percentage of stocks. It's like 4% in the US and 6% globally. So if you're going to be an investor, an active investor, if you're going to be a stock picker, then you should have the courage of your convictions and have a
RSI 32.
If you want
to our second trade,
stocks or 20 stocks or 75 stocks, it's almost irrelevant, but it shouldn't be 1,000 or 2,000 stocks.
Nice, nice.
That is especially helpful if you're marrying it to the S&P 500 or the Vanguard Total Market. Hey, if you own 3,000 stocks in the Vanguard Total Market Index, then you can have a chunk of your portfolio, 5, 10, 15%, in a concentrated 30 or 20 stock index or a 30 stock actively managed set of holdings. But the combination is what makes it work so well together.
Folks, what you just heard there from Mr. Ritholtz is a combined wisdom of hundreds and hundreds of years of the Ritholtz clan that goes back. Barry Ritholtz, thank you so much. Greatly appreciate this comment on Mr. Lynch. I'll get that story out on Twitter. Lisa, I can't say enough what Barry just said there about the academic research, much of it out of Vanderbilt and UMass Amherst, on too much diversification. Peter Lynch used the phrase diversification.
If you have conviction, why not just go with it and concentrate your bets? And we have seen that certainly increasingly in equity markets and certainly among certain hedge funds. Taking a step back, though, when you talk about the game changing, the key aspect here is a lower benchmark yield. When you have a lower yield point, how much more do fees matter? How much does it crimp the ability to be effectively active? And that, I think, has been a challenge on an ongoing basis.
Huge challenge. There's no question about it. The diminution of the rate structure over 15 years has made the active cost ever more painful. This has been interesting. Thank you to Barry Reynolds. Thanks to our team for bringing up that great Tom Maroney, Joe Short Sleeve story from Bloomberg. We continue an active day here.
Are we going to get the spike? Are we going to get the push up now? 3 minutes. Remember, always 30 minutes before the open. Remember, we always get a little push. So I wonder if it could be time to get another buy back in again on US-30. Or size 31, we'll just wait and see. And again, we'll just go 50 points in the reverse direction. There you go, you got 223 actually. So, but we are looking to take a sell on the open. Remember, we're looking for this second leg, as you can see. So any buys are just like short buys. We're hoping for this, we didn't get it. Fine. Not at the moment anyway. If it breaks this, then we're carrying on down, but I think we're going to go no further than the trend line till the open. But we'll see. Gold now pulling up. Perfect. And there is room here for 100 points maybe. Watch that on gold.
Clearly, neither side are taking any chances.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the Q3 was the quarter that was most affected.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. What happened to the sell-off from New York City for our audience worldwide? Good morning, good morning. Here's the bounce from yesterday into Tuesday, up 58 on the S&P, advancing more than 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, finding opportunities in the volatility.
This time round, it's going to be volatility.
2022 is going to be macro volatility.
That volatility of volatility.
It's going to be Fed hikes, it's going to be virus, it's going to be those kind of things.
The Fed is taking away the punch bowl, possibly.
You're going to see the Fed have to move a little more aggressively.
You're worried about all of this.
Which is going to create all sorts of interesting opportunities.
A worried market's a great time to be an investor.
Pretty substantial walls of worry.
The volatility is here to stay.
And that means fundamentally a lot of pockets of fixed income credit investments are going to be good places to be.
It might be a little rough in the fixed income markets.
You're going to be wanting to be long S&P.
The market is certainly where I want to be.
Volatility is going to be large and more substantial.
And that's just the world we're living in today.
Joining us now on this discussion, I'm pleased to say, is PGIM's Greg Peters, Patrick Palfrey of Credit Suisse, and very shortly, a little bit later in the program, we'll catch up with Jill Carey-Hall of Bank of America. Greg, I want to start with this market. For all the talk of all the things to get worried, concerned about, I've done this a few times this week already. We're a couple of percentage points from all-time highs on the S&P 500, Greg. What do you make of this?
Well, I mean, we're kind of looking through everything at this point in time, but just because we're here now doesn't mean we're there tomorrow. And I think that is really the message. And so I completely agree with the prologue of this program, which is volatility, I think, is on the rise. There's so much uncertainty. Valuations are much more stretched. You have central banks really kind of looking the other way, it seems to me. And I think we're in for a much more volatile ride going forward. But at the same time, I do agree it's a great opportunity going forward.
Well, let's talk about where those opportunities are. Patrick, where are those opportunities right now for you?
Well, for us, we see the biggest opportunities in a few cyclical areas. Energy, as oil continues to rebound, and we think there's structural reasons why oil should be moving higher here. And with that, I think materials and industrials benefit. And I think those investors with longer term time horizons can really take a look at technology. I think there's concerns around the valuations, but when we take a look at the expected GDP growth out a couple years, those companies are really driving their own success. They're going to continue to deliver on the top line. And we don't view the valuations as being concerning when you look out a couple years. So depending on your time horizons, I think tech works really well here.
Well, let's talk about that, because if you have a longer time horizon, you might get that low growth profile again. But with that, you might get higher rates. Isn't that the key piece of this, Patrick? If you get low growth and low rates, then growth equities works, big tech. Does it work if you get higher rates?
I think it becomes more difficult when you get higher rates. And I think when we're talking higher rates, we're talking a 10-year, well above 2.5. I think the question that investors need to be asking themselves is, can we, and we believe we can be, in an environment where we have incrementally higher inflation, but rates remain contained? In that environment, corporations have a tremendous opportunity to grow sales, to grow the bottom line, but not get penalized from a discount rate. So you get the valuations to work and you get the profits to work. And that is a tremendous scenario. That's what we're in right now. And we think that scenario actually persists.
That's why I'm looking forward to catching up with Jill Carey-Hall of Bank of America, because their call is as follows. What happens to the Tina argument if cash yields rival the S&P 500's 1.3% dividend yield, and if the 10-year yield hits 2% by year-end next year? Greg Peters, when it comes to the fixed income side of this call, you do think rates will be contained. You and the team, PGIM,
25 minutes to go. Back watching. US-30 not starting its drop. Now just pulling up a little bit. So, like I said, we might get a cheeky buy before we zoom in for the open.
You were at peak growth, peak inflation, peak stimulus, both from a fiscal and monetary standpoint.
Measure that and see.
And that's all you
94 back to our next points of interest line.
There's an expectation with all that behind us that rates are all of a sudden going to accelerate higher. It's an argument I just don't really quite understand.
Is that not in the logical sequencing that the central bank is offering us right now, Greg? I think that's where you've got to have the disagreement. Some people believe that we're about to pare back QE quicker and that automatically sets us up for a rate hike. Others say it's about building in flexibility. What gives you the confidence it's about the latter and not the former? It's not about just a direct path towards a series of rate hikes through next year and beyond, Greg.
Well, so look at what the bond market has told you over the past month or so, right? So as the Fed and other central banks have abandoned kind of their slower approach, the front end has moved and the back end has rallied, right? So what the bond market is telling you is that the economy can't necessarily handle higher rates. And that's why the curve has flattened. And as you mentioned before, it's back to where it started a year ago. So I think the bond market is quite clear in telling the equity market, central bankers, that if you hike too much, if you actually hike what's in the market currently, you are slowing down the economy in such a way that you're getting closer to a recession.
So, Greg, I want to get a call on the front end and then go across the board and what it would mean for equities. 2-year yields this morning were 5 basis points to 68. How contained do you think a potential move at the front end is, Greg, with everything you've told us? What's the limits of that move?
I think we're kind of close to the limit already. So, the move has been quite dramatic thus far, a big change over the past 6 months. I struggle with a lot more movement in the front end, honestly. But if I'm wrong around that, then I'm much, much more bullish on the intermediate and back end. So to me, the most important metric to evaluate in the markets today, all markets, is the path of the 2-year. If the 2-year continues to move to higher levels, I actually think that rings the death knell for risk assets going forward.
And Patrick, is that what you're focused on as well? What happens at the front end of this yield curve?
Well, for us, we're taking a view of the long end. And I think what it comes down to is what the long end signals, and that's demand for capital. And we talk about why interest rates are as low as they are. I think if you look out a couple years, we have a structurally lower GDP environment going forward. Certainly right now, we're recovering on an economic bounce, but that's expected to really begin to slow over the next 1 to 2 years. So you have to ask yourself, what is the terminal level of GDP? And it's slower than where we were before for demographic reasons. So when you take that view, it's not surprising that the 10-year isn't really higher here. So I think cyclicals work as a trade coming out of the economic recovery in this bounce. But I think longer-term technology and those companies that are really driving their own success are absolutely where you want to be.
Just get to the index level quickly, Patrick. Where does that leave multiples? This was the call from Morgan Stanley over the weekend. A new COVID variant started the ruckus for markets, but we view that as secondary to the real culprit, the Fed's more aggressive response to the on-fire data. It's been hot. Lower valuations is our call for 22. Tapering is tightening. What's your view on multiples at the index level, Patrick, into next year?
Well, I think in a weird way, I think we actually agree with Morgan Stanley, but I think our view is a little bit different. We see multiples as lower incrementally because profits are continuing to grow incredibly strongly. So the E is growing faster than the P, therefore multiples fall. Do we view multiples as compressing because of the various risks in the market? At the moment, we don't see that. We think the profits are going to be the reason why multiples come in incrementally, but ultimately the backdrop remains tremendously healthy right now.
Throw in credit to that conversation, Greg. What's the risk-reward profile like in, say, high yield in the United States after the little bit of spread widening we've seen over the last few months?
I'm actually more excited about credit in 2022 than I was this year. So we're quite bullish on high yield. I still think that is the case. But the investment grade corporate market is the real interesting part of the market, I think. So spreads are actually wider year to date in spite of the really strong growth backdrop and in spite of deleveraging. So I actually think risk reward investment grade corporates is looking increasingly interesting. And I think capital will start to shift as we get to 2022, as I think credit is looking relatively more attractive versus equities, whereas you could not say that was the case over the past 18 months.
How many moves have you made recently, Greg? Have you sat on your hands? Have you just sat this one out? Or have you made some moves in the last week?
Well, so I think it always pays to be a long-term investor. So I think the short term is really, really difficult here. And so we were just kind of debating going into this interview amongst ourselves, are you going to have a year-end rally or a year-end sell-off? I think it's really a coin flip. I think it's that difficult to ascertain. So I think you need to take a longer-term perspective, you have to tune out the white noise and you have to focus on what your medium to longer term value proposition is. And I think when you do that, you start to see more opportunities still in high yield, still in investment grade, and then local rates in EM is the area, I think, for 2022.
What I hear from both of you, though, and we can return to that call in just a moment, is that there is this belief, this conviction from both of you that we go back to this low growth world, down towards trend growth of, say, 2% in America, and maybe threatening to break below that. Patrick, what would make you sit there and say, you know what, maybe we don't? Maybe this could continue, not at this rate because nominal growth is explosive right now, but maybe something above 2, 3, 4%. Why do you truly believe we haven't broken out of that low growth world?
Well, I think ultimately what it comes down to is the demographic factors which drive real GDP. At the end of the day, your GDP is really a function of how many people you can put to work and then how productive those individuals are. We can't make more people, and we definitely can't make them in short order. So we are stuck with the population growth that we have, and that is going to be around 1.5% over the next couple decades. So the question becomes, can productivity be that bountiful increase that drives us meaningfully above it? In a lot of ways, I think the answer is not really. And oftentimes people think of productivity as a benefit from technological innovation, but that does a disservice to technological innovation that's been happening over the past hundreds of years. So the invention of the light bulb, which elongates the workday, people cast that aside and they say, well, we now know where a train is on the train track because of the Internet of Things. Does that make it more productive? It's certainly helpful, but does it meaningfully alter the productivity of an individual employee? I think the conversation, is difficult to have. And we don't think productivity is going to be that driver to really offset the demographic factors.
Hey, Greg, I hear a similar thing from you as well. You just don't believe we've broken out of the low growth world that existed and persisted before the pandemic.
No, I agree. I agree with the
We've got 15 minutes to go.
Absolutely. Also, let's not forget.
I'm going to go and grab a coffee while we watch. Look at that beautiful W pattern now going to form again on gold. We're expecting gold to be a further buy on the open. Depends where it's sat. Could get a pullback before we get the buy. And same on US-30. We want it to just pump up a little bit so we can get the drop down. Because obviously now our TP for the open is going to be just above our buy here. So we're going to be looking at this now for the NY. Again, you could get a little pump up to this level here. Look. On the open, depends where price action is sat before.
The Federal Reserve doesn't want to effectively punt the December meeting further out.
You've got some news kind of 30 minutes after the open, but that's about it.
24 hours and 3 big central bank decisions coming right up.
And look at DAX, exactly the same, not waiting to take the drop.
So I think for too long, wealth management has just been for the wealthy. And what ETFs have done is they allowed us to scale products and services that are easy to understand, they're simple to use, and they're cost effective across more than
think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has 3 very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the US, New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the US to the UK, and now it's open, of course, to UK nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
This is a market that
over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
When you start late, at some point, developments on the ground force you to go faster than you would normally want to go. And if you go faster than you normally want to go, you risk breaking something. And that's the problem of a highly leveraged economy, is that if you are late, you risk making a policy mistake.
We're counting down to 3 big central bank decisions. SocGen expecting the Bank of England to wait until February to make a rate move, saying the following: delaying to a time when there will be less uncertainty about both COVID and the economy makes sense. By contrast, the FOMC on the 15th should still see a decision in favour of faster tapering. That's an easy sell by a hawk to a dove because it commits the Fed to nothing on rates. That makes sense. Then one ECB official confused everyone, suggesting a move on rates before winding down QE. The governor, Holtzman, saying the following: I've always been against linking the bond purchase programme and rate hikes too closely. Interest rates could be increased while net purchases are still in progress. Mike McKee joins us now for more. Morning, Mike.
Good morning, John. Well, we know Mr. Holtzman is a rather hawkish fellow, and it doesn't make a lot of sense to raise rates while you're still trying to stimulate the economy because you're working against yourself. But that doesn't mean there's going to be a lot of focus on the ECB this week, and the Fed and the Bank of England, as the world's major central banks come to a fork in the road. The major QE assistance they have provided to the global economy and their own economies starting to fade out. Here's the Fed, and here's what we're going to be watching, John. Everybody knows the Fed is likely to taper.
US-30 approaching the 25. We'll move our TP down for the open. 10 minutes left anyway, that's fine.
Sort of priced in for 2022.
Gold going up, US-30 going down as guided by the news. We've got the manipulation on gold, we didn't get it on US-30. Now we're waiting. We get a spike up. This is going to be our TP now for the open.
2.5% has been their forecast forever. But if inflation is really a problem, do they need to move that up? So that's the
price has moved quite a bit, back to 1781, which is great. We want gold to get back to that, 1800 zone ideally. We'll stick with US-30 while we get ready. 10 minutes to go. Just see if there's anything printed on investing.com.
Almost 4 rate hikes in 2022.
Nothing really.
They'll probably get started in February if they need to do that many.
Watching that.
For them and everybody else, Omicron, but by that time, maybe it will be better. And then we go to the European Central Bank, which is going to be the outlier here. They are expected to announce an end to the pandemic emergency purchase program, ending it in March. They'll keep going until then. But there is a lot of pushback against Mr. Holtzman from members of the Governing Council, including President Christine Lagarde, who say there's no reason to raise rates now. You can see why they would get rid of PEP, though. It was designed, those are the PEP purchases in blue, it was designed to pull the economy up and raise inflation. And it did that for quite a while, but now we've got inflation without a whole lot of benefit from the PEP program. So you can expect a lot of changes next week. It is time for people, I guess, to start changing their investment portfolios. You know what Yogi Berra, the American baseball player, said, John, when you come to a fork in the road, take it.
Thanks, Mike. It's helpful, isn't it? Mike McKee, thank you, sir. Mike McKee on a week ahead, and what a week ahead it is. The Federal Reserve kicking things off, followed by the ECB and the Bank of England. The big conversation is very much about liftoff. When do we get that liftoff? What's the sequencing of the whole thing? And then what are the limits of that effort to raise interest rates? Joining us now is Joe Carey-Hall, Greg Peters and Patrick Palfrey still with us. Greg, I want to come to you on sequencing, and then I'll come to you on the equity market. Joe, thank you for being so patient with us. Greg, the sequencing here, is that confusing to you from the ECB? Just want a fish line now, slightly hawkish, maybe very, very contrarian, should consider him an outlier. Would it be complex to say we'll continue doing QE, but you know what, let's hike interest rates?
Yeah, I mean, it doesn't make much sense, clearly, but it speaks to just how the communication is so varied and so confusing across the board. And so you're having a lot of rhetoric coming out of all central banks, and it's giving mixed messages. And more importantly, what you're seeing is just dramatic shifts. What the market's like is consistency, right? Not dogmatic, but consistent. And what we're seeing happen by central banks today is radical shifts, right? You've seen it with the BOE earlier this year. You saw it with Powell last week. And so I just feel like this added rhetoric coming out of global central banks is just a vol event, honestly.
It's very difficult to understand. You consider it a vol event, other people consider it to be much more material, something that's going to be living with us through next year. Morgan Stanley's Ellen Zentner saying this: we now expect, in fact, this is from Bank of America, we now expect the Fed to end its QE program in March. We still expect liftoff in June, but March is in play. Jill Carey-Hall, wanted to come to you on that Bank of America quote, because I know that you are less constructive on the equity market. You think Tina is facing a massive threat right now because you believe this central bank has to hike.
Yeah, we're only forecasting a flattish market through next year. We have a 4,600 year-end target on the S&P 500, and you have the Fed tightening into a overvalued market. You have very bullish equity sentiment. You have earnings growth slowing to trend. We actually think dividend growth will be better than earnings growth next year. But with the rise in rates, we would expect that the argument, Tina, as you mentioned, that there is no alternative argument for equities gets more called into question if cash yields are rising, so that dividend yield on the S&P 500 isn't as attractive as it once was. So for us, we see more opportunities within pockets of the market rather than just buying the S&P 500 for next year.
Jill, we've had a conversation earlier in the program, and I appreciate we had some technical problems, and our apologies for that. Patrick Palfrey, much more constructive. Greg Peters as well, suggesting that there are limits to how high the Federal Reserve can go. Can you give me some insight into how high you think they go with the team at economics over at Bank of America, and what you think the break point will be for the index level story?
Well, we expect, and as you mentioned earlier, that the liftoff is expected to be in June based on our economists' forecast, but could be as early as March. Obviously, the taper timeline has been accelerated, and we're expecting that they hike rates 3 times next year and then continue the pace of tightening into the year after. So, equity markets tend to actually be up during the heightening cycle, but as we mentioned earlier, we are seeing very elevated valuations, Fed tightening into an overvalued market, which can be more detrimental. For small caps, which is an area that I cover, we also do tend to see rather lackluster returns once the Fed starts tightening. So that is one potential risk. But I think one of the big differences today is that small caps are actually trading at a pretty hefty discount to larger stocks. So it's actually the only tightening cycle that we're heading into besides 1999, where smaller stocks weren't expensive versus larger stocks. So, potentially one difference in going into this tightening cycle.
We're going to build on this still ahead. Jill, Patrick, Greg, coming up, the morning calls, and later, Apple and Intel leading the charge in the pre-market, helping extend the rally for big tech into a second consecutive session. From New York City, this is Bloomberg.
US-30, look at that, had a re-entry there, cheeky little re-entry. Would you have taken that? Maybe, maybe not. Again, it's a quick scalp because look, it was already, if you got in there, you could have got 50 pips in and out because you're right on a support zone. That's how you've got to do with these ones. These are extra bonus trades that you just get in and out on. So now we're just waiting for the open. It's nice that it pulls up like that. Same as on this. Dropping, just ranging a little bit now before the open.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Five minutes away from the opening bell in New York City this morning. Here's the bounce at 1.2% on the S&P 500. On the Nasdaq, a nice rally, a tiny one at 1.7% on the Nasdaq 100. That's the equity price action. Here are your morning calls. We begin first up with Guggenheim, downgrading to neutral. The analysts expecting competitive headwinds and weakening sales of its COVID-19 medication. We're down there 1.93% to 72.
We've got about 3 minutes, 2 or 3 minutes to go.
Starbucks to abide, the analysts taking a more constructive view of the company's longer-term prospects. We're positive there by almost 1.9% at 115.12. And finally, Morgan Stanley raising its Apple price target to a street high 200, matching Dan Ives over at Wedbush. The analyst Katie Huberty seeing benefits from new product categories. That stock at 169, up by 2.28%. Coming up, big tech pointing to another big day of gains. That's next. This is Bloomberg.
The world's urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities.
Right, let's have a look. Let's get ready. Let's get our broker open. Let's see where we're going to go.
And with sea levels rising, 800 million residents are likely to be affected.
In on gold.
1.9 degrees.
Okay, we've got about 30 seconds to go.
Is the projected increase.
Good luck, everybody. Let's see. Let's see if we get a little push up and down.
1.6 billion people are projected to be vulnerable to chronic extreme heat.
Just gonna let all these ride. About 1 minute to go.
Access the financial world on demand. Here are leading economists, policymakers, and industry experts. The alive and on-demand webinars. Only
US-30.
Start exploring to see what's moving the markets.
Let's see.
Visit Bloomberg.com webinars.
Beautiful little move on US-30. It was great. Beautiful. Up, something down.
think that it's hard to put your head around any narrative.
Ooh.
Just to be honest, we've had sort of a shift in, are we in some sort
Brilliant,
of
we just close that and we're
moment? We're talking about that all day yesterday.
Let's have a look for gold. Oh, beautiful. Beautiful, beautiful, beautiful. And we got 34 and 26, 28 and 10. Perfect. Look at that move. Just as I said. Hit the TP on the open. Let's get back in on US-30. Let's get back in on US-30. There's still a little bit more to do on this, I think. Look on US-30. See if we can catch it going grey, dropping back out of that zone. Well, 4 trades so far.
Over the last couple of months, negative 0.4% there on euro dollar. Crude up 2.5%, 71.24. Around the opening bow, then about 25 seconds in, we advance 1.2%, leading
New York Open. Look again. There's still room for
more than 2% for that industry group.
push up on gold.
On a day like this morning, we're basically unchanged on utilities. We'll turn back to IT in just a moment. Victoria Green of G Squared weighed in on where she thinks the risk reward is right now. Take a listen.
We think value is a really great place to be a little more.
And into another 4 trades. Just watching for the RSI.
Industrials, I think those are some better plays right now. Tech has been difficult, and some of that might be with the potential of the 10-year and coming up and not hurting the discount rate. But we think the market is certainly where I want to be. Overweight equity.
Ranging perfectly. US-30 again.
Market bears just as much risk as the equity market.
Yeah, let's get another out of those. Just close those trades down on US-30.
Green, overweight stocks. Back with us, Jill Kerry Hall, Patrick Palfrey, Greg Peters. Patrick, I want to come to you. We missed you last time around. My apologies for that. Start with your index.
Print the Widons.
You still believe the risk reward makes sense for the index.
6 trades so far. We're out in 1 second. So we've got 17, 22, 34, 28, 28, and 9 so far.
On it earlier, when the Fed hikes, it's typically a good backdrop for equities. Because we need to remember why the Fed hikes. What they are doing typically is
All done in 2 minutes.
Cycle. That is a good period for equities. I think right now
Trading.
there's a concern around inflation, but inflation is a positive for profits, particularly when you don't have the offset from higher interest rates, and we're not seeing that right now. So I think there's a lot of reasons to be positive. I think the concerns potentially be if China growth slows, or perhaps
The US-30. Okay, spiked down to there and it's gone up for a buy. Beautiful. And get the buy on that.
Those seem to be also helping out the market. So we see a very constructive backdrop at the moment.
Jill, to be clear here, Bank of America is very constructive on the economy, just not constructive on the index. We de-emphasize the index level call and focus on what's happening beneath. Can you just return to that for us, Jill? Why is that?
30, 60, 90. That's like $200 on the open there. Perfect. Now I'm going to catch this. I'm going to get this. I'm going to catch this.
Concentrated in a lot of mega cap growth stocks, such that
US-30
has actually become extremely interest rate sensitive,
pull back.
more so than historically. So rising rates should be a bigger headwind for a lot of these growth stocks. And we, as fiscal and monetary stimulus wane, if we see volatility,
Again, when it reaches a level of resistance support, you can look for the pullback, 50 to 100 points. What we're looking at now.
With value over growth, assuming that the COVID backdrop, we don't see a major resurgence.
We're out. Oh my lord, what a win. That's amazing, amazing, amazing. We've got 110, 57 and 15. We've got another $300 there. Oh man, brilliant.
We expect that to remain an engine of growth next year, and smaller stocks are bigger beneficiaries of that, and the continued recovery in services spending and the capex recovery, again, if COVID stays at bay.
And Greg, I wanted to bring you back in and finish on this. You mentioned that tilt towards EM. Just briefly, I wanted to return to it. Why is that, Greg?
Well, so EM has really lagged here over the past 18 months. It's been atypical, right? The global growth story is typically quite good for EM, kind of a high beta play. It's been largely a value trap across fixed income and equities for good reason over the past 18 months. Just the struggle with vaccinations and the virus broadly But there's a lot of bad news in the price currently. There's lots of rate hikes.
Perfect. See if US-30 is going to drop back any more now.
And we think global inflation is, subsiding.
Bring this round.
Together, and it seems like a pretty
And gold, is gold going to push up any more? Maybe. Look at that, it's going to spike. See if it breaks this zone.
Start to see value there for sure.
Greg Smart, as always. Greg Peters alongside Patrick.
Perfect, we caught it both ways. Just amazing scalping. Just say you got to do it.
We advance by 1.4% on the S&P utilities.
So we're gonna hang on for another 30 minutes.
2%. SocGen saying this, seeing the dip buying strategy continuing to be profitable. Let's get you to
retail
Taylor
investors looking to buy the dip, because this has been a strategy that's been highly profitable over the past few years. And the Omicron variant really creates uncertainty, but it doesn't really change the story. And as a result, we think that momentum will carry on.
That's the way TV goes sometimes, Taylor Riggs. I apologise. Taylor, good morning.
I'm just glad I'm ready for you, John. Let's take it away. Take a look, and you really mentioned some of that dip buying. Where we are, you've seen that at least when it comes to the Qs and some of the inflows that you see in the ETFs. Take a look at last week. You had one of the largest inflows that we've had now since June, right as the index was dipping, and that is continuing a little bit again this week. So you're really starting to see some of those inflows when it comes in here for some of the big tech names. As we
Wait and see.
John, I wanted to reiterate today, that's a very different story when we're looking at some of the Chinese technology names. How much of that is sort of that macro story on individual names of slowing growth? How much of that is some concerns about a big crackdown on big tech and some U.S. concerns about some of the transparency with the actual fundamentals? So with some of those like JD.com and Pinduoduo that were down the worst in some of the last week of some of those individual names. I will mention, though, leading here to the upside, at least on the day, let's get back to some of this micro news. Intel, of course, is a big mover on the day. They're looking at what could be a $50 billion IPO unit. Morgan Stanley saying that this news is a significant positive. When you think about generating value from the business on a conglomerate discount versus a sum of the parts, could it be worth more and freeing up some capital? Apple's another one that we're really looking at here, John. You're up almost 2% now, more than 2%. Katie Huberty now raising the price target to 200, matching the street high from Wedbush. Really talking about virtual reality here and maybe that giving that stock a boost.
Taylor Riggs, thank you. And our apologies for that again.
All
Taylor,
good.
as always, professional and ready. Thank you very much. JMP Securities CEO Mark Lehman looking at more volatility to come, saying investors should, quote, buy the broken winners, the stocks that went up quickly and then fell when we believe things were going back to normal. You want to own sectors being disintermediated by technology. Mark Lehman joins us now, the CEO of JMP Securities, a Citizens company. Mark, just start there for us. Build on that, please.
Well, we had a theme of 2020 with technology and stay at home as being the dominant theme for investors for last year. That theme has kind of been roiled by the back to work trade for 2021. But I think a lot of what investors saw in 2020 is here to stay. That is, we're not going to go back to the office 24/7. We're using technology more for all of our daily lives and different facets of our daily life. And I think that is a roadmap for the future. A lot of those stocks have not had a great 2021. But if you pick through those names that have been afflicted there versus 2020, I think roadmap ahead is to own the tech winners for the long term. And there's a 50% off sale in some of those names you want to take advantage of.
Just some of those names, Mark, Zoom, Peloton. Are we ever going to evolve, get away from just considering them stay-at-home stocks? Do we ever get away from that, Mark?
I think we do. I mean, I think...
Gold attempting another break, look.
We've had some names that we used to call them technology stocks, but technology really pervades our entire life. And you look at all...
I'm looking for, yeah, still looking for USA to pull back a little bit.
Whether it is tech
Our line setting here, TPs, we can move this up now.
You accustomed to that.
Our flat KG line, we'll get rid of this one.
We're just going to be, that's just our future.
It's what true scalping is all about. Wait for the opportunity. Look at the RSI dipping down. I like to see these nice peaks on the RSI. That's looking good. And on gold, same, wants to break. RSI's, yes, great. It's hovering. watch and see. So there's no economic news really. We've got this economic optimism, quite interesting one. So a quick read. I'm sure I've done it before.
Do the value of these stories matter, Mark?
America's economy.
They do. I mean, I think we had a
By expected figure and expected to be 45. So
we're saying, well, if we could pay 50 times revenue, why can't we pay 100 times revenue? And in the last 3,
we will see. Gold is breaking. We're in profit on gold.
Why do we want to own them at 50 times revenue? I think eventually these companies have to turn
brilliant, brilliant, brilliant. And we just got another $100. There it is. It broke. That's all I needed on gold. Was that it hit the TP? Look, perfect. We've got 42.60 and 28.98. So what's that? 40, 60, 70. So £70. That's about $100. Yeah, there you go. Bang! We smashed it today. All we want now is an additional sell, possibly on US-30, but it's looking bullish. You see a strong bull, 78%, so we're not rushing into anything. We've got no positions open at the moment. Let's post that result, because that should be, is probably pretty much it.
There's others that we have here at JP that are going to own markets that are changing, that they're changing. We have a company called DOMA, which is digitizing the title process for all of us who buy a home. When you buy your home today, it is basically replicating the closing process that your parents had and your grandparents had. That is going to change. We think DOMA is going to be the winner in that digitizing process. That's what we're looking for at JP.
DocuSign was another one of those companies, and then it had a 40% rout, 42.22% rout on Friday. Mark, I'm trying to understand.
There you go, look at that, it's hit the TP. Perfecto.
How do they do it? What do they avoid? What's the best way of getting investment exposure to this without getting the exposure to a single day move and getting wiped out to the likes of DocuSign?
Well, it really was jarring. They did report their earnings on Thursday, and like you said, the 40% rout. But look at the 2 and 3 and 5 year charts of DocuSign. And there were a lot of doubters 5 years ago who obviously benefited over time. And yes, we are going to have more competition in that space. But I think you got to look at valuation. You have to look at what the earnings are.
That's what it's all about, you see, going both ways.
Good for any story. It's certainly not good for
perfect. That's what you got to do.
Investors obviously have to pay attention.
Look to go both ways. The true scalper. We're not bothered. We're just reading price action, looking at the fundamentals to give us the momentum.
I think everybody had to recalibrate what they're paying for those stories, including DocuSign, and they missed their numbers. And you're going to get punished when you miss your numbers. And I think the stories that I'm talking about are their growth is accelerating. DocuSign's was not. And I think that's the real fundamental calibration investors have to make. And it's a very perilous journey when you invest in high growth, high multiple stocks, and they miss their numbers. And DocuSign's an example of that. The few that I've given you, I think, are still ascending.
All the trades from the open.
And a place that investors can pay attention to.
Mark, thank you, sir, for being with us. It's been too long. Mark Lehman there of JMP. Your equity market up 1.4% on the S&P, on the NASDAQ up 2. Coming up on the program, US and European allies weighing Russian bank sanctions if Putin invades Ukraine.
Results.
The administration isn't certain that Putin is planning an invasion, but they do.
Again, not every day is like this. My results are not typical, of course, because I'm experienced. Yeah, but this is the kind of level you can achieve if you practice. You know, join the group, have me as your mentor, and practice every day, whether it's on demo, whether a small account or a big account. It's all about taking the trades, practicing the art of true scalping. We're done today. Not so many trades today because not so many news events, but that's nice. It's been a nice smooth day. That's sometimes what you want. Less stress. US-30 still pushing up. Look at that. I missed that. Re-entry. Didn't have him over screen. Got a nice re-entry on the buy on US-30. Gonna fill that wick. Bonus trades. Going with the trend.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he
I
say about me? What did that particular gentleman say about? Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
Brilliant. There we go. In and out. One on that there. Beautiful.
Summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
That was a bonus trade. Bonus trades they were. Beautiful.
Even if there was an invasion, that has not been something that's
Two positions again every time.
that these economic sanctions would be impactful enough and would have such an impactful effect on the Russian economy and on the Russian people that it wouldn't be worth
What, 38 and 20 on that? Another 50, another $80. Perfect.
The US weighing Russian bank sanctions should Putin invade Ukraine. This coming as President Biden prepares to speak with the president later today. For more, let's bring in Josh Wingrove from outside the White House. Morning, Josh. What are you looking for later?
Well, I think the breadcrumbs, Jonathan, to look for in this will come in the readouts and the statements from White House Press Secretary Jen Psaki. Some of the analysts we've spoken to have said, look, if they're talking about a lot of things, that might mean that Putin might not get all that much of a direct message on Ukraine, but if the statements are all about Ukraine, in particular, if the Russians sort of frame it as Putin getting what he wanted, that could be a sign of de-escalation. As for the package that Biden is expected to sketch out, this is a joint EU-US measures targeting banks, the Russian Direct Investment Fund, as well as currency conversion, Forex, to try to hamstring, if you will, Putin, give him a consequence of any measures he might take. They think, though, that he has not decided what to do. The big question we have, though, is what the U.S. will do if Putin takes half measures, if you will. They're framing this as sort of an all-or-nothing response. We don't know what will happen if it's more of a gradual or shades of gray incursion or some other type of interference in Ukraine by the Russians.
Josh, there's a difference between punishment and getting countries to change the way they behave. As a punishment, this can be severe. We've seen what's happened in North Korea. We see what happens in Iran, for instance. But when it comes to changing behavior, I don't see much evidence of that for North Korea, for Iran, for Russia for that matter either, Josh. What are they focused on, just a punishment or actually trying to change the behavior of this country?
Well, I think they want a so-called stable and predictable relationship, but you're right. I mean, we're back where we were in some ways 7 years ago with the invasion of Crimea and the lack of settlement, if you will, in the Donbass. And at the time, the U.S. responded and NATO responded by cycling troops through eastern flank NATO allies. If there is any sort of incursion into Ukraine, you could probably expect to see that again. But they think it's easier to sort of back Putin off, if you will, by sort of threatening stuff before he does something rather than using these measures to get him to back down once he's actually done it. Now, the U.S. officials say they don't believe Putin has made a decision on what to do in Ukraine, and that, of course, leaves them sort of trying to affect his risk, cost-benefit analysis, and by trying to sort of lay out a credible threat. Now, whether Putin believes that this is a credible threat is a million-dollar question. And if he does move forward, then other things potentially go on the table, including the Nord Stream 2 pipeline.
Yep.
Of course, Germany supports that. That might waver. And the questions of SWIFT transfers, that's sort of a nuclear option. So far, the EU and US aren't expected to be sort of mucking about with that.
Josh, thank you. As always, Josh Wingrove there from outside the White House. The tension between Russia and the United States right now. Here's some tension between the United States and China. The Biden administration boycotting the Beijing Winter Olympics. It's a diplomatic boycott. The White House press secretary, Jen Psaki, making the announcement.
The Biden administration will not send any diplomatic or official representation to the Beijing 2022 Winter Olympics and Paralympic Games, given the PRC's ongoing genocide and crimes against humanity in Xinjiang and other human rights abuses.
For the latest, let's bring in Bloomberg's Joe Matthew. Morning, Joe.
Good morning. What a contrast to hear these two stories back to back, Jonathan. What is it we're talking about here? You've got two countries who are in the midst of this whole debate here, and a major world leader essentially threatening countermeasures against the U.S. for not attending a party that the U.S. was not invited to. Isn't that what this actually is? Look, we're still sending our athletes there, and you've been referencing, Jonathan, throughout the morning, the statement from Press Secretary Jen Psaki that referred to genocide. We are still allowing U.S. athletes to attend. We're not the only country that's not going, by the way. This morning, New Zealand announced it would go and said that COVID might have something to do with it. The fact that we're not attending, the fact that Joe Biden's not going to be in the stands does not seem to be quite the controversy that the Chinese are making this out to be. But
look at US-30 fly, brilliant. That's great. Good move there. And that was a final cheeky buy. Gold's now pushing down, so you can look for a sell in a minute on the neutral zone here. That would be good.
And crimes against humanity in Xinjiang. Do you think that a diplomatic boycott is consistent with that kind of allegation that's coming from the US government? Is it consistent to see corporate leaders in America apologizing to the Communist Party? That language is coming out of the administration.
I'm not sure that there's anything consistent on either side of this whole thing. Right. If the concern here is boycotting a country and trying to respond to genocide, how come we're going to be playing ball? On the other hand, for the Chinese to weigh in with to bring the thunder.
Well, that's it. So in the end, we've
what are those countermeasures? Are they not going to attend the summit?
nailed about 25 trades for the day. It's looking.
They weren't invited to that either.
For good reason. Joe Matthew, thank you, sir. Joe, good to catch up. Looking forward to the coverage later through the day, especially sound on Bloomberg Radio, 5 p.m. Eastern Time. Let's get you some sector price action. Here's Kriti Gupta.
Well, good morning, John. Another day.
28 trades. 28 trades, all winners, and we've hit our TP for the day. No positions open anymore. And that's it. Just wanted to show you again how you can do, we've been scalping an hour and a half, 90 minutes, we're done. That's it. So again, you can follow the price action, follow our charts, our post setups in the VIP Discord groups if you want to join and get access to all this I'm showing on a daily basis. And we talk about crypto as well. And obviously join the team and go to the website www.mohawkforex.com. So until the next live stream, which we'll probably do a later end of New York session live stream. So until then, everybody, take care and trade safe and keep up the true scalping. And see you all soon. Take care.